The casino chip shuffle. Picture this. You walk into a Las Vegas casino with a briefcase containing $100,000 in cash from sources you'd rather not explain to the IRS. The bills smell like crime, but in a few hours they'll smell like opportunity. The mechanics are almost elegant. You exchange your unexplained cash for chips, which is completely unremarkable because casinos process more cash in a day than most people see in a lifetime. Then comes the performance. You sit at the blackjack table, play some poker, hit the roulette wheel, not to win, but to create the appearance of legitimate gambling. You might even deliberately lose 10 to 15% to make it look realistic. After a few hours of theatrical gambling, you cash out for a check or wire transfer. Suddenly, your criminal proceeds have become documented casino winnings. The casino provides official records showing you gambled and won money, creating a paper trail that explains everything. The beauty was its simplicity. Someone walking into a bank with $50,000 triggers automatic reporting requirements. Someone walking into a casino with $50,000 is just another Tuesday night. Some sophisticated operators didn't even gamble much. They'd buy chips, wander around looking busy, play low-stakes slots, then cash out most of their original amount. Modern casinos caught on eventually. They now monitor customers who exchange large amounts for chips but don't actually gamble. But back in the day, this was essentially a money cleaning service with a neon sign advertising its hours. Next is loan-back schemes, basically borrowing from yourself. You've got $2 million in dirty money sitting offshore in a shell company you control. You can't just wire it to yourself. That triggers every alarm the Treasury Department owns. So instead, you borrow it from yourself with interest. Your Cayman Islands shell company loans you $2 million at 8% annual interest. You sign loan documents prepared by a legitimate law firm who doesn't ask uncomfortable questions. The money transfers to your U.S. bank account as a legal loan, which isn't taxable income because loans aren't income. You're supposed to pay them back. Here's the beauty. You now have $2 million in clean, explainable money in your domestic account. When anyone asks where it came from, you show them loan documents from an international investment company. Everything looks legitimate. Proper contracts, proper interest rates, proper legal paperwork. The fact that you secretly own the company lending you money, that's buried under 3 layers of shell corporations registered in jurisdictions that don't share information. You make monthly interest payments back to your own shell company, which is actually just moving money in circles, but it creates a paper trail of legitimate debt servicing. Some operators even default on these loans strategically, then negotiate settlements for pennies on the dollar with themselves. The forgiven debt becomes taxable income, which they pay taxes on, further legitimizing everything. The sophistication comes from using actual lawyers, actual loan documents, and actual international companies. They're just all controlled by the same person. It's financial theater where you're every actor on stage, but the audience only sees legitimate business transactions. Modern enforcement looks for loans from companies with no apparent business purpose, loans with unusually favorable terms, loans to individuals with no clear ability to repay, or loans from jurisdictions famous for financial opacity. When investigators discover the borrower secretly controls the lender, suddenly that legitimate loan looks like money laundering with extra steps, which is exactly what it is. Next up, Hawala, the black money network. Imagine moving $100,000 from New York to Bangkok without a single dollar crossing any border. No wire transfer, no bank account, no paper trail, just a phone call and a code word. This is Hawala, an ancient money transfer system that operates completely outside formal banking networks, making it nearly impossible for law enforcement to trace. Here's how it works. Criminal A in New York gives $100,000 to Hawala broker A. Broker A contacts broker B in Pakistan, who immediately gives $100,000 minus fees to criminal B. No money actually crossed borders. The brokers just owe each other $100,000, which they'll settle later through legitimate trade transactions or future Hawala transfers in the opposite direction. The genius of Hawala for criminals is its complete invisibility. No formal records, no bank accounts, no wire transfers, no paper trail. The only evidence is verbal agreements between brokers who often never meet face-to-face and communicate through coded phone calls. Some Hawala networks handle billions of dollars annually through networks spanning dozens of countries. They're faster than traditional banking, charge lower fees than wire transfers, and operate 24/7 without banking hours or weekend restrictions. Next is the laundromat method. This is literally where the term money laundering originated, using actual laundromats to wash dirty money until it comes out clean. Laundromats, car washes, pizza joints, nail salons, parking lots. Anywhere customers pay with crumpled bills instead of credit cards becomes a potential cleaning service. The trick isn't hiding money. It's hiding it in plain sight by drowning it in legitimate revenue. You buy a functioning pizza restaurant. It operates normally, serves actual pizza to real customers, employs real staff, passes real health inspections. Everything is legitimate except for one detail. You're inflating the sales numbers. Tuesday's actual sales hit $5,000. You report $12,000. That extra $7,000 comes from your criminal proceeds, deposited alongside legitimate revenue. You paid taxes on those phantom pizza sales. The IRS gets their cut. Suddenly, your dirty money has become taxed business income with documentation showing it came from selling pepperoni to families. Here's what makes this difficult. You actually have to run successful businesses. Real employees need paychecks. Real customers expect service. Real health inspectors show up unannounced. Real inventory needs ordering. You can't just claim your laundromat washed 1 million loads last month if you only bought enough detergent for 10,000 loads. The ratios matter. If your restaurant realistically seats 200 customers daily, you can't claim 500 without raising flags. You need to inflate gradually and believably. Maybe 250 customers instead of 200. The art is knowing how much fake revenue your legitimate operation can credibly support. But investigators know the patterns. That small-town laundromat reporting revenue like a Manhattan location? Suspicious. The restaurant claiming higher per-customer spending than industry averages by 40%? Interesting. The car wash that's supposedly busier than Chick-fil-A, but has an empty parking lot every time they drive past? Time for an audit. It proves that even crime requires entrepreneurial talent and work ethic. Next is online gaming. Massively multiplayer online games have virtual economies worth billions. And where there's virtual currency that converts to real currency, there's money laundering. Welcome to the newest washing machine. Fantasy worlds where criminals clean money by selling digital swords and imaginary real estate. Here's how it works. Buy $100,000 worth of in-game currency using dirty money through peer-to-peer exchanges or third-party websites that do not verify identity. Use that currency to purchase rare virtual items, legendary weapons, limited edition skins, virtual real estate in metaverse platforms. These items have real market value because other players will pay actual money for them. Now, you sell these virtual goods to your own alternate accounts or to accomplices who pay you with clean money through legitimate payment processors like PayPal or credit cards. The gaming platform's records show you sold virtual items for real money, which looks like normal gaming activity. Thousands of people make actual income selling virtual goods. You're just one more entrepreneur in the digital economy. The gaming companies usually take a percentage of transactions, which legitimizes everything further. You're paying transaction fees to a major corporation for selling virtual products. It looks less like money laundering and more like participating in the gig economy, except your gig involves converting criminal proceeds into legitimate e-commerce revenue. Some operations use casino games within online games, essentially creating layers of gambling-based laundering inside virtual worlds. Others exploit blockchain-based games where virtual assets exist as NFTs, non-fungible tokens that can be bought and sold anonymously on cryptocurrency exchanges. Buy an NFT for $50,000 using dirty crypto, sell it to yourself from a different wallet for $45,000 in clean crypto, and the blockchain records show a legitimate market transaction. The sophistication escalates with professional gold farming operations. Businesses in developing countries where workers play games all day, accumulating virtual currency and items, which are then sold internationally. Criminals can insert their own dirty money into these existing commercial pipelines, mixing it with legitimate gold farming revenue until the original source becomes untraceable. Gaming companies are catching on, implementing anti-money laundering systems that flag unusual purchasing patterns, accounts that buy high-value items but don't actually play the game, or coordinated transactions between related accounts. But the fundamental challenge is that distinguishing legitimate hardcore gamers spending thousands on virtual items from criminals laundering money is genuinely difficult. It proves that money laundering evolves with technology. Every new digital economy becomes a potential washing machine. Today it's online games and virtual worlds. Tomorrow it might be something that doesn't exist yet. Criminals are often early adopters of new technology. Not because they're visionary, but because new systems haven't built enforcement mechanisms yet. Next is layering, aka international wire transfers. Layering is where dirty money gets passed through so many transactions across so many jurisdictions that tracing its origin becomes practically impossible. It's a 3-card Monte with bank accounts, except the cards are spread across 50 countries. The money starts in the United States and gets wired to a bank account in Panama. From there it moves to an investment account in Luxembourg, then to a cryptocurrency exchange in Malta, then to a shell company account in the Cayman Islands. Each transfer creates a new paper trail while burying previous ones under layers of international bureaucracy. Shell companies are crucial because they exist solely on paper but can legally send and receive money. You create Panama Marketing Solutions, which sends money to Luxembourg Capital Management, which invests in Malta Digital Holdings, which transfers funds to Caribbean investment partners. Each company appears legitimate with proper registration documents, but they're all controlled by the same person. The sophistication escalates with each layer. Money moves between banks, investment accounts, real estate purchases, cryptocurrency exchanges, precious metals dealers, and art galleries. It bounces between countries with strong banking secrecy laws and jurisdictions with different reporting requirements. The challenge for investigators is that each jurisdiction has different legal systems, different reporting requirements, and different levels of cooperation with international law enforcement. By the time authorities in one country identify suspicious activity, the money has already moved through 3 other countries with completely different legal frameworks. Next up, inside job of bank complicity. Sometimes money laundering succeeds because financial institutions either look the other way or actively participate in schemes. The FinCEN files revealed that major international banks processed over $2 trillion in potentially suspicious transactions while knowing the money might be linked to criminal activity. Corrupt bank employees can disable monitoring systems, ignore suspicious activity reports, or create fake accounts specifically for laundering operations. Some offshore banks built entire business models around attracting money that does not want to be tracked, offering numbered accounts, bearer bonds, minimal documentation, and explicit policies of not cooperating with foreign investigations. Some jurisdictions depend so heavily on financial services revenue that regulators avoid enforcing anti-money laundering laws too strictly. When banks become crucial to local economies, governments don't ask too many questions about where the money comes from. Regulatory capture transforms enforcement agencies into enablers. Next up, real estate, building wealth on paper. Real estate might be the most popular money laundering vehicle because properties can absorb enormous amounts of money in single transactions while providing seemingly legitimate explanations for wealth. You buy a luxury condo in Miami for $5 million using dirty money routed through shell companies. The property sits empty for 2 years while appreciating in value. Then you sell it for $5.2 million, and suddenly your criminal proceeds have become legitimate real estate investment returns. The beauty is that real estate transactions naturally involve large sums, complex ownership structures, professional intermediaries who ask few questions, and extended timelines that make the original source of funds harder to trace. Many luxury properties are purchased through shell companies that obscure the actual owner's identity. Sometimes even the real estate agents don't know who really bought the property. Some operations flip the same properties repeatedly between related shell companies, each transaction creating new documentation and further obscuring the original source of funds. Others use mortgages and refinancing to layer the money. You buy a $3 million property with $1 million in dirty cash and a $2 million mortgage, then refinance repeatedly, each time extracting equity that appears legitimate. All-cash real estate purchases are particularly attractive because they avoid mortgage lenders who might ask uncomfortable questions about source of funds. Walking into a luxury real estate closing with millions in cash from shell companies triggers fewer alarms than you'd expect, especially in cities that specialize in high-end real estate for foreign buyers. Next is black market of the art market. The high-end art market is custom designed for money laundering, almost as if criminals wrote the rules themselves. Art transactions involve enormous sums of money, subjective valuations, minimal documentation requirements, and guaranteed privacy for buyers and sellers. You buy a painting for $100,000 using dirty money. The painting sits in a climate-controlled storage facility for 2 years while you wait for its value to appreciate. Then you sell it through an auction house for $800,000. The auction house takes a commission but doesn't ask questions about where your original purchase money came from. The proceeds appear to be legitimate art investment returns. The beauty is that art valuations are completely subjective. What makes one painting worth $1 million and another worth $100 million? Expert opinions, market trends, provenance. Essentially, collective agreement plus marketing. This subjectivity makes it nearly impossible to prove the price is artificially inflated for laundering purposes. Some operations create entire fake art markets. They use shell companies to buy paintings, artificially inflate prices through staged auctions with fake bidders, establish false provenance through complicit galleries, then sell to themselves at massively inflated prices, all while moving dirty money through the system disguised as art transactions. The art market's obsession with privacy works perfectly for criminals, anonymous buyers, confidential sales, offshore storage facilities. Many transactions occur in free ports, special jurisdictions where goods can be stored indefinitely without customs clearance or taxation. Your painting never technically enters any country, existing in a legal gray zone perfect for hiding assets. Next up, cryptocurrency. Digital laundering. Cryptocurrency promised financial privacy and decentralization, which criminals immediately recognized as perfect for money laundering. While blockchain transactions are theoretically traceable, the practical reality involves enough complexity to make tracking difficult, especially when combined with other techniques. You start by purchasing Bitcoin with dirty cash through peer-to-peer exchanges or Bitcoin ATMs that don't require identity verification. Then you move the cryptocurrency through multiple wallets, often using mixing services or tumblers that combine your coins with thousands of others, making the trail nearly impossible to follow. From there, you might convert Bitcoin to Monero, a privacy-focused cryptocurrency designed to be untraceable. After several conversions between different cryptocurrencies, you sell for clean cash through another peer-to-peer exchange in a different country. The blockchain shows all the transactions, but connecting them to specific individuals becomes practically impossible. Some sophisticated operations use decentralized exchanges that don't require identity verification, trade across multiple blockchains to further obscure trails, and ultimately convert to stablecoins or other cryptocurrencies before cashing out. The technology moves faster than regulation, creating temporary gaps that criminals exploit before law enforcement catches up.